I'd love to start on China, since it did seem to play an important role in your lowered guidance for the year. Can you give us some specifics in terms of what you're seeing there? I know you highlighted as a growth headwind not only cloud, but also enterprise and communication services providers as well. Is it your sense that this weakness in China is going to continue for some time?
You know, David, the China market is a significant market for us and has been a big source of growth for us over time. If you look at what happened last year, is the demand for China was significant. The cloud service providers through the first 9 months of the year last year were up almost 100%. And the question coming into the fourth quarter and the first quarter this year is what kind of digestion would we see of that massive growth from last year? And what we've experienced over the last couple quarters and what we see going forward is that consumption of the significant demand that we experienced last year is going to take a little bit longer. And that will be across all three of our segments within the data center business, the cloud, enterprise and government, and comm service providers.
I know as part of your outlook for the client computing group in particular, revenue at least remains unchanged. It does seem to be pointing to your expectation that the second half of the year is going to see a significant improvement. What confidence can you offer your investor base that, in fact, that will become the case, given things have not started off particularly well?
Yeah, the client business in the quarter had a pretty good quarter. We're up 5% revenue. Unit volume was down. And in the first half of the year, the demand signals have remained relatively strong. And we don't expect different demand signals in the second half. What we do expect is we're going to improve the supply constraints that we've had in the first half of the year. And we believe by the second half that we'll have more capacity in place and being able to meet the demand profile that we're seeing throughout the course of the year. So it's less about a changing demand profile on the client side. It's more about getting more capacity in place to meet the demand profile we've seen over the last couple of years and we expect for this year.
Bob, with the stock now down about 10%, I mean, obviously it seems investors are just wondering how much they have to reset expectations for the longer-term trend, perhaps for the industry-wide kind of cloud investment cycle. What can you say about your guidance and how it bears on the very sort of longer-term capacity for that market to keep driving growth?
Yeah, you know, Michael, the trend that we've seen, the demands for data and the need to store, process, to analyze that data, those end demand signals are as strong as they've ever been. Whether it's in the enterprise or whether it's in activities of consumers, demand profile is extremely strong for the industry. And it's really it's just more lumpy buying patterns that we see, particularly in cloud, where they buy, then they consume, they buy, then they consume. And with the demand profile at the end remaining relatively strong, we think medium and long term is going to be very beneficial for our business. We're just dealing with the lumpiness right now.
You know, Bob, I mean, Goldman Sachs this morning comes out, though, and the lead of their review of your numbers is CPU demand appears to be weakening across multiple end markets, enterprise, cloud, and communication services providers, more than offsetting your efforts to reduce operating expenses. I would assume then you don't agree with that thesis.
Yeah, I think, David, the distinction I would make is the end market, the demand for data, the creation of data, and the compute, the analytics, and the storage required are very strong, and they haven't really changed. How chips get bought is a little lumpier than the end market. End market stays relatively strong. Last year was a huge year for our DCG business with 21% growth. Now we're just going through the digestion period, but the end markets we think are relatively strong.
You decided to, as you say, focus in the 5G business, or change your focus to some extent, or sharpen it, I think actually was the word. Why are you no longer in the business of selling 5G chips, or would be in the business of selling 5G chips into wireless smartphones?
So the 5G market for us is extremely important. It has been and it always will be, and our expectations are we'll lead in 5G. When we talk about leading in 5G, it's primarily at the network. And we believe 5G will bring about this convergence of communications and compute at the networks, at the comm service providers, and at the telcos. That's primarily where we'll play. We have a very strong position. We see high growth characteristics, technology inflection, and we can make money for our investors. That's our primary focus. We're also looking at opportunities for modems, connectivity at the edge, and Internet of Things, and in the proliferation of devices that are going to benefit from lower latency in a 5G world. In the smartphones in particular, we've just concluded that we don't see an opportunity to make money. So we decided in the last couple of weeks we'll continue to focus on 5G at the network. We'll continue to evaluate opportunities of a 5G modem at the edge. But in the smartphone arena, we just concluded we don't see a path to profitability, and therefore don't want to divert our resources where we don't see opportunities to get attractive returns for our investors.
And Bob, is there no path to profitability there in that smartphone market because of the Apple and Qualcomm settlement? Does that play a big part in this?
I mean, obviously, we have a large customer in the smartphone arena that we're serving today in the 4G or LTE world, and we'll continue to serve them. As we looked at going to the 5G world, we look at all the dynamics, characteristics going on, and we always try to conclude, do we have a real technology differentiation where we can make money? And in light of the dynamics in the market, we've made the conclusion that we do not, and therefore we made the decision to exit the 5G smartphone modem market.
Bob, just a question on capital allocation. Your guidance for this year is for $15.5 billion in capital spending. Obviously, you're a constant and very large CapEx spender, but also in the first quarter, I guess, bought back stock at a rate of about $10 billion annual rate, around there, $2.5 billion in the quarter. Is there any changes in thinking around that equation in terms of how you would allocate capital in those directions, whether because of potential policy changes or valuation of the stock or any other reasons?
You know, our biggest capital allocation decisions are around putting in the capacity required to serve our customers, and we're a significant R&D investor, so we're investing in the leading technology inflection. Those are the biggest components of our capital, and in 2018 and in 2019, our CapEx is as high as it's ever been in the company's history, and that's a function of the investments we're making to grow the business. In terms of distribution to shareholders, a key component of our capital allocation has always been organic investments first, strategic acquisitions second, where they make sense, and third, paying an attractive dividend and taking advantage of a disconnect in what we believe the intrinsic value of the firm is, and using our strong balance sheet and our cash flows to reduce outstanding float when we think it makes sense. In the first quarter, you saw that, and you've seen that over the course of the last couple of years, is where we think it's opportunistic. We're using our strong balance sheet to take advantage of a disconnect in what we believe the intrinsic value is.
Well, Bob, on the call you said you were honored with the best job in the world when you got it a little more than a little less than 3 months ago. Today, with your stock down 10%, is it still the best job in the world?
Absolutely. The opportunity to improve is endless. It's about as this company, the technologies we build, the impact we have on the world is significant. And I'm as honored today as I was 90 days ago, and I'm looking forward to talking to you 90 days from now.